Hello, everyone, and welcome to the IR Update. Today with us, we have Ed Nobrodsky, CEO of DotAI. Hello, Ed.
Hi, Amanda. Thanks for having me on.
Thank you for joining us today. So, Ed, for investors encountering DotAI for the first time, how would you describe what the company does and what makes your asset intelligence platform distinct from traditional IoT tracking or supply chain visibility solutions?
Yeah, a question I get asked all the time. So the simplest way to think about it is our name, .ai. It's really two parts that our company is built on. Tracking the dots, connecting the dots, doing the asset tracking, as you mentioned. We have a whole set of product suite that is just about collecting those things. And what makes us unique about that? The first is we're the only company doing an industrial ambient IoT. Ambient IoT being a technology being presented now in the retail space and really taking traction with companies like Walmart and Amazon. We're very excited to work in those supply chains and cross docks and downstream applications to enable this as this new generation, I'll call it, of RFID comes to market. We have some unique patent technology in that area, but we also take data in from other systems like barcode and RFID that are there from other places. So in terms of tracking the dots, we think we're different because we collect from multiple data sources and we have a unique adaptation of ambient IoT that is going to be the next generation of tracking. On the AI side, which is the second half of our name, we have AI enhanced workflows with a really advanced rules engine that does machine learning, incorporates cameras and object recognition, and allows you to streamline your workflows with AI implementations. So putting those two together, there's not a lot of companies that can do both of those together the way we do. And that's what makes us special.
Ed, 2025 was a landmark year. You completed your business combination, began trading on Nasdaq, and you delivered a $5.8 million in full year revenue, including a record $4.5 million in Q4 alone. So what were the key operational drivers behind that Q4 acceleration, and what does that trajectory signal for 2026?
That was a really busy year for us. As you mentioned, that business combination agreement, going public on the NASDAQ, it certainly took us down some paths we weren't fully prepared to do and hit us in our operational side. But we were able to emerge from pre-revenue and, as you said, close a good fourth quarter. So what does that mean? The sales in the fourth quarter, as we said in our 10K, were largely hardware-based as we moved some of our unique hardware out into the marketplace to begin to be installed in projects. The core of our business is the SaaS revenue that we obtain. As those objects get enrolled in our SaaS software, we charge subscription fees monthly for their use within that tracking application and the AI workflows. So what you're seeing is a shift of revenue from 2025 of hardware into 2026 of software and subscriptions. So you'll see that as per our revenue guidance, we'll see some growth, but the biggest growth will be in the margins and in the order book as it looks at 5-year contracts over SaaS revenue going forward. That's the big transition of 26. 26, we hope to talk a lot about subscribers and subscriptions and the ways that our SaaS is moving forward and less about the hardware, although there'll still be some hardware moving.
And you recently completed your DoveMatrix 3.0 platform, which features a multi-tenant SaaS architecture built for enterprise scale deployments. So what does this next-gen platform enable the version 2.0 could not, and how central it is to your path toward recurring subscription revenue?
Yeah, our customers are really part of a strategy I would call land and expand. We solve one local problem, then we solve multiple local problems, then we start going across multiple sites. So our customers are demanding that we can support their logistics operations across a multinational footprint. In the 2.0 version of our software, we really weren't set up for a really good multi-tenant cascading type architecture that we needed to support that. And this significant move, Gen 3 was a significant redesign for us to get our architecture aligned with the market. It allows us to service those customers in a way that's really leading edge and really can do the job for them.
And they also built a growing partner ecosystem with Kentag Group in Australia, Wiliot for Ambient IoT, and Würth Industry North America for industrial supply chain applications. How do those partnerships expand your commercial reach, and what does the international distribution model look like as you scale?
Yeah, that's an important part of our strategy. Scaling our partnerships is really, really critical to our operations, and it's the focus of our sales team. As you may know, we're a partner-focused organization. We sell through channel. We don't sell direct to our customer base. So the Würth partnership that was announced previously, they act as a distributor for us, and they hold inventory. They service all of our VARs around the world, as well as servicing their own internal customers. That's an important part. On a technical side, the Wiliot partnership is really critical as we work with them on gathering data signals, ambient IoT, temperature measurements in a really inexpensive and efficient way in the marketplace. So we collaborate with Wiliot on a technical and a commercial level to expand that footprint of that particular technology and to move it forward. Many VARs like Kentag all over the world that are working through different verticals and different regions. We'll be announcing a lot more of those here in this coming year. This is a year of our partnership expansions into those areas. So what does that do? That takes our core technologies into places like healthcare and logistics and transportation and construction and mining. We seek VARs that are experts and have a footprint in these vertical industries that can take our core technology and apply them to those use cases. Because ultimately, when we're tracking the dots and we're adding AI, it doesn't matter what industry it is, whether you're in a hospital or a construction yard, these technologies have great applicability.
And as our last question, looking at your 2026 revenue guidance of $6 to $7.5 million, what are the biggest pipeline conversion catalysts, and how do you expect the mix to shift between hardware and software subscriptions over the course of the year?
Yeah, it's really important to make that clear because many have talked to me about that revenue guidance. Why is it so low? Why aren't we expanding so much faster? The challenge is going from the hardware sales of 25 into subscription sales of 26. We're selling 5-year subscription contracts, which means we only recognize the revenue in the first of those 5 years. So the hardware is a leading indicator of software sales. So the fact that we close so strong in 25 is a really good sign that all that hardware has to be enrolled in 26 and become SaaS. But we have to be tempered in our guidance in that only a fifth of that SaaS revenue will be recognized in the period, even less probably because we'll have less than the full period. And so we have to be careful about the guidance on it. So the closing of that many subscriptions to close the year with a higher volume of booked contracts really tells you the next 3 or 4 years are well set up for recurring revenue with ARR that's already locked in.
Excellent. Thank you so much for joining us today.
You're welcome. I appreciate talking with you.
You too. Thank you, everyone.